Welcome to the InterMarket Analysis video update. This is a video that I do once a week where I not only look inside the stock market outside of the S&P 500, I also look at a lot of different markets to try to get some insight and clues as to what might be happening within the stock market. No market exists in a vacuum. And so what may happen in the bond market or in the commodities market may end up having an impact on the stock market and the S&P 500. In fact, we saw that on Friday. The market was having a really difficult time going higher, and one of the reasons for that was that oil was going up pretty far, pretty fast, and I'll talk more about that in this video. This is being prepared for Tuesday, September 5th. We will be closed on Monday in observance of Labor Day. While I'm thinking about it, I want to wish everybody a very happy Labor Day weekend. I hope you can have a barbecue, maybe get together with some friends or just relax, maybe go on a trip. But all in all, I hope you have a really wonderful weekend. Before I get started in this, on Monday, September 4th, which is Labor Day, I will be offering a free online course. And it looks like I'm going to have to switch how I'm going to do that. It looks like I'm going to have to use Zoom now. I've been running some tests using YouTube and Rumble, and I'm having some trouble with that. And so I'm going to have to change the way I do this. I'll be updating on the community tab of the YouTube channel. I'll be recording a short video explaining that I'm going to have to change over and do this. It's just not working out the way I would like it to, mainly due to some bandwidth throttling that takes place based on where I'm residing right now. I don't seem to have that same problem when I use Zoom. So we're going to see if that works a little bit better. This is a 3-hour course that I'm offering on Monday, and it's going to be marathoned all the way through from start to finish. We'll start at about noon Eastern time on Monday and go till about 3 o'clock Eastern time. Now, for some of you, you're going to be busy. You're not going to have a chance to go to this class. I will be recording it, and I'll make it available on YouTube and Rumble. If you still want to partake in another live class the following week, instead of doing it in a 3-hour chunk, I'm going to do it in 3 1-hour chunks spread out over Monday, Tuesday, and Wednesday from September 11th through the 13th. What I'll be talking about is my overall approach to technical analysis. I have about 30 plus years of experience in this, and I've developed kind of my own way of doing that. And that's what has attracted a lot of you to the videos that I do, is that I look at things in a different way than what you may see elsewhere. I'm going to explain some of the reasons for all of that. I'm also going to be talking about some basic strategies. Now, I won't hit these at a real deep level. I'll just be kind of mentioning them and then how you would use them in different environments. And I'll also be talking about support and resistance. And I plan on spending about an hour on each topic. Let's go back and get into the intermarket analysis part. The first area that we look at is, how is the valuation of the S&P 500? Is it considered expensive? Is it considered cheap? Or is it just about right? Well, there's a couple of different ways we can look at this. One way is to look back using historical information and then comparing what were the price of stocks at any given time and what were the valuations at that time. Then we can also do a little bit more analysis historically, but then the market doesn't use that. They like to look forward. So we use this as a chance to look both backwards and forwards during this section of the video. The first chart that you see is historically going back, and we use a thing called the PE ratio. Earnings are what ultimately drives stock prices. If a company doesn't earn, their price, you can't justify their price going up. You probably would justify their price going down. And as earnings go up or down, so the stock market tends to go up or down. Now, we don't use these tools here for timing purposes. It's mainly just to get an idea, what's the condition of the overall market. When we're at a PE ratio of 20 or above, the market is considered to be expensive. Between 11 and 19, the market is fairly valued. And when we're at 10 or below, the market is considered to be inexpensive or cheap. What you see on the top here in this chart, the black line is the S&P, where we've been coming down lately as we hit some difficult times in August. The first line that we bump into is a red dashed line. That's a PE ratio of 20. You can see that we're well above that. And just to show you on a little bigger scale, that's what I measured down below. How far above is the S&P from the PE ratio of 20? So right now, On a historical basis, the market is considered to be overvalued, but it can go like this for a long time. We've been overvalued for a long time now, so we don't use this so much to make our decisions. We just look at this and go, man, the market's getting more fairly valued, or it's actually getting cheap right now. That would be a good time to buy. And a lot of folks that use fundamental analysis to be in the market, they might rely more heavily on this type of an approach. We can also compare that with different events that have happened, different crashes, different things that have occurred since 1980, just to see what were the valuations at that time. There are times when we became overvalued. There are other times when we became fairly valued. You'll notice that there aren't really any times here where we became undervalued as it applies to the S&P. There's another way that we can look at this using the Shiller PE ratio, where this looks at an average over a period of time. Over on the right-hand side, we're at 31.04. Well, what does that mean? We can compare it to the median and the mean, which is between 16 and 17. So on a historical basis, the market is considered to be almost twice as expensive as it should be. And then we can compare that with different events that have happened. Way back here, this red dot, that's 1929, and we're actually higher than we were at that point. Now, am I predicting a crash of some kind? No, not at all. We just want to be aware of where are we on a valuation basis. Here we have Black Monday. That was the 87 crash. So we can just use this to give us some context as to the overall market condition. But the market doesn't do that. They look forward and they use analyst estimates and forecasts and what they think the economy is going to do. And then they come up with another PE ratio that's going off into the future. That's called a forward PE ratio. And the S&P right now is under that 20 level. We still use the same scale, and we're currently getting a reading of 19. Just to give us a little bit more context, we look at the mid caps where we're under 15 at 14.1, and the small caps are under 14 at 13.9. So looking forward, the market is kind of hanging in there and doing okay. Now, the forecasts and projections, those can always change, and those can always be wrong too, but it's what the market uses to get some guidance as to what do they want to do. Do they want to buy? Do they want to sell? So this can change, and this does update every day. We compare all of these on one chart where we take the S&P, the mid caps, and the small caps, and then we can just look at them, and they have a tendency to go in the same direction. We also have two ways of looking at the small caps. There's the Russell 2000, which is, for a long time, that was the most popular index, and that's the red line, and it doesn't really fit into this 15, 20, 10 PE ratio. So what I also like to look at is the S&P 600 small cap, and that does fit into the 10, 15, 20 scale. And we just get an idea of what valuations are there between these two indexes. Then another area is growth versus value. When you want to buy low and sell high, you want growth stocks. When the market might be heading into some times of trouble, or maybe you're focused more on dividends or companies that have been around a long time, then you may want more value-oriented companies. The first thing that we look at is just an index of pure growth. And this is giving us a recent golden cross here, showing that growth is experiencing some improvement. Then we look at a value index where it's still in a longer term downtrend, but we could see a golden cross here pretty soon. Where it gets interesting is when we compare the two. We have a ratio of growth to value on the top, showing how growth is outperforming. And then down below, it's value versus growth, showing how growth or how value is underperforming. And the reason why I do these inverse charts and I look at lots of different things, you can see where sometimes they don't calculate in exactly the same way. So we just want to be seeing the same thing at the same time. We also look at some ETFs showing that growth is outperforming value. Here's an inverse showing how value is underperforming growth. We look at another index study showing how growth is outperforming and then how value is underperforming. And then the last chart just looks at another way of looking at an index showing that growth is outperforming value. So we take all of this together to give us some kind of a clue. Okay, growth is outperforming value right now. Now we need to break this down just a little bit further. We look at some different studies showing how growth is outperforming value, where it had really underperformed in 2022. And then we're seeing how value outperformed in 2022, and now it's underperforming. We break it down even more by looking at the small caps, where they've been going sideways, but they're still in a longer term uptrend when we compare small cap growth to small cap value. We look at the mid caps, which were really doing quite well earlier in the year, and then we hit the summertime and they've been chopping more or less sideways. We are seeing growth outperforming value now, but we're not really breaking out. We want to see this continue to go up if you're more positive on the market. Then this is the most important one for the S&P. This takes S&P growth versus value, where we're in a longer term uptrend. We had some weakness as we were coming into the summer. We're starting to recover now, but we haven't really broken out yet. So we keep an eye on this. And I cover this chart quite often in the daily videos that I do. We also keep an eye on inflation. We have a monthly chart, the CRB index on top, where it's starting to turn back more positive. And then down below, we have a ratio between inflationary areas and deflationary areas. When this ratio is going down, that means inflation is also going down. And that's being more confirmed by the economic reports that have been coming out lately. We keep an eye on the CRB index, which had been in a downtrend. Now it's starting to shift and go back into an uptrend. We want to be aware of that. If this really starts to take off and go up, that could be inflationary, which could hurt stocks. Then we look at the Baltic Dry Index. How much does it cost to ship products from one place to another? And there are people that do different studies, and they put an S&P on top of this and shift it forward 3.79 months. And I just look at this chart for what it is, and it's in an overall downtrend. So this is not suggesting that we're in an inflationary environment when it comes to Baltic shipping costs. Some other markets that we keep an eye on. We're not involved in these markets, but we just want to watch them from time to time. Aluminum is in a downtrend, so that's non-inflationary. Corn is also in a downtrend. Wheat is in a downtrend. It's been chopping all over the place. Fertilizer, which had been coming down, it was ticking back up, but continues to fall. Oil, which is starting to turn positive now, and it really shot up, and that kind of spooked the market later in the week last week. It's okay for oil to go up and stocks to go up at the same time, but when oil started to really shoot to the upside, that kind of freaks out the market a little bit. Gas, which is now turning into an overall uptrend, which we all feel that anytime we have to fill our gas tanks. Heating oil, which had been declining, is now starting to come back up, and we're getting near a golden cross with the price of heating oil. Natural gas, still in a longer term downtrend, but has been bouncing back up. We look at copper. This is a barometer of the economy. When copper's going up, most folks tend to think that the economy is looking rosier into the future. And then the inverse of that is also true. Well, we've been chopping sideways with copper for quite a while, and this has been going on long enough where we're seeing a death cross in this price chart. Then we compare copper to gold and take a ratio of that. When things are looking better economically, copper tends to outperform gold. When we're having some difficult economic times, gold tends to outperform copper. Well, we've been chopping more or less sideways right now, so it's not really telling us that much. Then we take a longer term look at that same ratio, copper to gold, and that's the black line, just to give us some more perspective. The green line is the 2-year yield, and the red line is the 10-year yield. Notice how they're inverted. And we're seeing right now that the spread between all of these is pretty wide, where even though they're on different scales, sometimes they don't get very far apart from each other. Also, in a healthier environment, they tend to move in the same general direction. Well, we've been seeing a wide spread in different directions now for a little over a year, and this is kind of suggesting that the economy that we've been in now, there's a lot of uncertainty as to what's going to happen going forward. Are we going to head into a recession? Is employment still going to stay strong? These markets try to figure that out, and they're not really coming to a definite answer right now. We look at gold, which is in a longer term uptrend and was able to get back above its 50-day moving average. We look at silver, also above its 50-day moving average and in an uptrend. Then we look at the closing price for gold on the top, and then silver in the middle, and then we take a correlation between the two. And it only stands to reason that if gold is going up, silver's probably going up. If one's going down, the other one's going down. Well, this chart just tells us that, yeah, that relationship is pretty strong, and they probably have a tendency to go in the same direction. Then we look at a gold to silver ratio on the top. So when this is going up, that means gold is outperforming. When this is going down, that means silver is outperforming. And what's interesting is we can then look at the US dollar index, And when this is going up, we make a general observation. We don't necessarily trade on this. It's just something good to know. When the dollar index is going up, gold outperforms silver. And so when the dollar's been going up, we see this ratio has been going up. When the dollar index is going down, then we tend to see silver outperforming gold. Both gold and silver can be in the same trend. They could be going up or they could be going down. It's which one is doing better at any given time. And it's kind of useful to know that. The problem with this chart right now is that we're seeing the relationship between the top chart and the middle chart. They're having a tendency to go in opposite directions. The dollar's been seeing some strength lately. And even though gold and silver are still in uptrends, they're really underperforming the dollar right now. And so they're having a tendency to go in opposite directions. So these general observations that I'm making right here, they're not as strong. When they do get as strong and we want to pay more attention to this is when this correlation comes back up and is giving us a higher reading. We also keep an eye on the dollar where it has been seeing some recent strength. We're seeing a golden cross on the weekly chart because the moving average, I have to clear my throat. This is actually take 2 of the video. I got almost finished with this video and I started coughing and hacking so bad I had to stop recording. So welcome to take 2 where I still have to clear my throat, I guess. Okay, on the weekly chart, the moving averages didn't get that far apart from each other, and that's showing some improvement. Where they got further apart here on the daily chart, we're still in a downtrend, but the dollar has been showing some recent strength. We keep an eye on the euro compared to the dollar, where it's been underperforming in the shorter term. We also look at the Japanese yen, which is in a downtrend compared to the dollar. Here's a standalone chart showing how the Japanese yen is in a downtrend. And then we look at the British pound. It's still in an overall uptrend, but it has been seeing some recent weakness. We look at some different indexes. We have the S&P 500, which is a weighted index. So the big companies, the mega caps that you've probably been hearing about, they have more of an influence on the S&P. Well, an alternative index is the equal weight index, where all of the stocks in the S&P 500, they're treated the same. And in a good, solid environment, when all stocks are participating in a move, we see the red line above the black line here, which is the S&P 500. And then lately, as we've been seeing some weakness in the market, the equal weight index has been underperforming the S&P. It's showing some improvement as both indexes have been turning back up recently, but we're not really seeing it outperform right now. And that's probably why you're hearing that it's the mega caps, the Magnificent Seven or the Great Eight or whatever you want to call them. They've been doing most of the weight lifting, if you will, in 2023. And we don't mind that if we just invest in the S&P, but this can be kind of frustrating if you're looking outside of those big companies to try to find some good, decent stocks, and you're not seeing the real performance that you're seeing within the indexes or in some of the big companies. We do a ratio between the S&P and the CRB index. Even though we're in a longer-term uptrend showing that the S&P is outperforming, we're seeing some strength in the CRB, so that's why we're seeing this ratio going down. The next chart is an inverse of that, showing how the CRB had been underperforming, but starting to show some strength compared to the S&P. When we look at the NASDAQ 100 and compare it with the S&P 500, they both have done quite well in 2023, but the NASDAQ 100 has been outperforming. We look at the biggest stocks that make up the S&P 500, which is the S&P 100, and the bigger stocks are outperforming the rest of the S&P. The NASDAQ has been outperforming the S&P. Now, there's a lot of stocks in both indexes, but it's the tech areas that seem to be outperforming. We compare the NASDAQ 100, the big companies, with the rest of the NASDAQ, showing how, yes, in fact, the mega caps and the really big companies are outperforming the rest of the NASDAQ. Then we look at the really, really big stocks and compare it with the equal weight ratio. And this is also showing what we kind of already know, that it's the big stocks that are outperforming the rest of the market. We also do a ratio between small caps and the S&P. That's the red line, where they have really been suffering in 2023. For things to turn more positive, we want to see this red line going up, and it has actually been declining. Then we compare the small caps with the S&P 500, showing again how the small caps are underperforming. We look at the 30 biggest U.S. software companies. They showed some weakness in August, came down to their 200-day moving average, bouncing back up, but have not been able to get back above their 50-period moving average. Here's the really big companies where they are just screaming to the upside, seeing a bit of a pullback in August. And now, at least, they look like they're trying to recuperate some of the pullback that we saw. Robotics and AI, that's kind of the real craze right now. It was doing well in this ETF, although we're seeing some recent weakness. But the interesting thing is when you compare it to the tech sector, it's really underperforming by quite a bit. When we look at the Dow Jones Composite Average, which takes the Dow, the transports, and the utilities and puts them together, we're in a longer term uptrend, but we've been doing a lot of sideways action in 2023. We compare the S&P with shorter term bonds based on price, showing how stocks are outperforming bonds. We look at a broad market measure when we compare it to further out bonds, showing that stocks are outperforming. So even though it's been the big mega caps that have really been outperforming, this is showing more broad participation when you compare it to further out bonds. We look at the low volatility ETF, which has been chopping more or less sideways, and then we compare what happened in 2022 compared to the S&P, and then what's been happening in 2023, where the low volatility stocks are really underperforming. Now, what's interesting about this is that we're coming down and matching this low that we set in late 2021. That's about the time the NASDAQ topped. So we want to keep an eye on this. Are we going to continue to fall and the market's going to turn even more positive? Or could this signal that we might be getting into some kind of a top? We look at the tech sector and compare it with 3 to 7 year bonds, showing how tech is outperforming after seeing some recent weakness. Then we look at the S&P and compare it with other stocks. This is an advanced decline line studies. We have the NYSE just common stock on the top, then the S&P mid caps and small caps. And we're seeing a lot of improvement across the board. We're seeing a little bit of a lag here with the small caps where they are improving, but they're not breaking out the way the other indexes are. Then we take traditional Dow theory on the top, and we have the transports down in the middle, and these are holding up okay right now. The Dow looked like it might be breaking down below this breakout point where it shot to the upside, but then it was able to turn and go back up. The transports came down and seemed to have hit support. But lately, the Dow has been outperforming the transports. And then I add utilities to traditional Dow theory, where they're just really having a difficult time in 2023. We look at a ratio between the transports and the S&P. When this line is going up, that means the transports are outperforming. When this line is going down, that means they're underperforming. In a good, solid environment, we want to see this ratio going up. And we're not really seeing that, even though we had a good week this last week as far as the S&P is concerned. We look at a ratio between the Dow and the transports. When this is going up, the Dow's outperforming. When this is going down, the transports are outperforming. Well, this had been going down, but we're still not really seeing a lot of strength currently in the transports. So to turn more positive, we want to see this ratio turn and go back down. We compare the relationship between the S&P 500 and the transports. Their relationship isn't as strong, where they're having a tendency to go in the same direction at the same time. It is showing some improvement, but there are times when they're pretty much going in lockstep with each other, but we're not quite at that point now. Here's a new look at Dow theory, where instead of using the Dow, we replace it with the S&P 500, since that may be a better representation of the U.S. economy. And then instead of using the transports, which is basically when it was created, built around railroad stocks, well, what runs our economy now? What's the big thing now? It's tech, and that's pretty much led by the NASDAQ. And we look for some kind of divergences or convergences in this chart, and we're not really seeing anything right now. They're pretty much confirming each other. The FANG index, Facebook, Apple, Amazon, Netflix, Google, and a bunch of other ones. I just haven't changed the acronym. We're in a longer term uptrend. We fell below the 50-day moving average, but now we've been able to close back above that. So this is showing some improvement. Longer term, we came back and set a new all-time high earlier, but then we fell back down, and we're trying to make a run to come back up. Will we be able to get back above this previous high and eventually come back and match the new all-time high and possibly go up? Or are we going to see some weakness going forward? We look at ARK. A lot of people are in that. Finally switched over to an uptrend where it generated a golden cross, and it looked like it was doing quite well. Then with everything else, it started to see some weakness, came down to its 200-day moving average, and has been bouncing back up, but has not been able to get above its 50-day moving average. Then we look at the S&P and compare it with stocks in Europe, Australia, Asia, and the Far East. On the top, and this is a monthly chart, we're showing that longer term, the S&P is outperforming global stocks. That's also confirmed by the PPO on the bottom, where we were able to cross above zero. So longer term, we're showing some good momentum. We compare stocks with bonds. This is where we're seeing some weakness. The total bond ETF is giving us a recent death cross. We look at world bonds, also seeing a recent death cross here as bond prices have been really suffering. And this stands to reason here that on a monthly chart, stocks have been outperforming bonds. This suggests that bonds are underperforming stocks on a shorter term basis. We look at high yield corporate bonds, which are junk bonds, and they tend to be holding up quite well, and they're still in a longer term uptrend. Even though folks have to take on more risk to get into these bonds, they're finding the yields rather attractive right now, especially when you compare it to investment grade bonds. We're getting close to seeing a death cross here as interest rates have been going back up and prices been going down as the overall market has been under some pressure. We compare riskier bonds with more conservative bonds. And kind of what I just said here is that folks are still tending to prefer the riskier bonds. We look at a correlation between stocks and bonds, and the price of stocks and the price of bonds are having a pretty strong tendency to go in the same direction. Bonds have been under pressure, and until this past week, stocks have been under pressure, and that's why this correlation is still pretty strong. We look at the Dow Jones Corporate Bond Index. We've been pretty much going sideways right now, but we're still in a longer-term uptrend. Keeping an eye on the 10-year yield, this could be something we want to keep an eye on. We came back and broke above this 100% retracement level, which means we were breaking out with yields. That started to freak out the market. Well, interest rates have now been starting to come back down. If we continue to fall, that might be positive for stocks. If we turn and go back up, that could be negative for stocks. A longer term look at the yield on the 10-year, going back to 1980, and this was pointed out by Chris Shavako from Shavako Capital, and I would highly recommend watching his weekly videos that he puts on YouTube, where we've been seeing over the last 40 years or so, lower highs and lower lows when it comes to the 10-year yield or the interest rates. Now we're starting to see what could be a shift where we're breaking out and maybe we're coming back into the old normal, where this decline that we saw, that was the new normal. And a lot of people are getting used to that, thinking that it's always going to be that way. Maybe we're going back to the way it used to be, where we do live in a higher interest rate environment. We don't know that. And we'll only know that by looking back and getting some hindsight. We just want to keep an eye on this. Looking at the 30-year yield, where it's still above the 61.8% retracement level with the fib charts. And then we're looking at what's kind of interesting here. This is a ratio between the S&P and the rise or fall in interest rates, where the S&P had been outperforming, but now we got into a difficult August and we're starting to see a death cross with this ratio. If stocks continue to show some improvement, we would like to see this ratio start to go back up. Keeping an eye on junk bonds, which they're in a longer term uptrend. We compare junk bonds with government bonds and more conservative corporate bonds, where the junk bonds are outperforming. Then we look at price, and I usually show this chart in the daily videos that I do. This is looking rather negative. We're dropping below 50 with the RSI, having a recent death cross with the trend. The MACD is still positive, but if we see more weakness, this could roll over and actually turn more negative. Then we look at a daily chart of the different maturities in the US market, where we had been declining with interest rates, and that gave support to stocks throughout the week. Well, in Friday's session, we saw interest rates going back up, and that put some pressure on stocks. Looking at a weekly chart internationally, the UK still has the highest interest rates, even though they're coming down, followed by the US and then Germany. And then the red area down here, that's Japan. And I'm keeping an eye on this. And if that becomes an issue, I'll start to talk lots more about it. Then we have a study of the 5-year yield. This is a monthly chart. No, I'm sorry. This is a daily chart where we're above this moving average. But this is kind of hard to understand here. The special K, which is a momentum oscillator, still shows that we're in a longer-term downtrend. I don't know what to make of that one. The KST, which is another momentum oscillator, is slightly positive, but is pretty much going sideways. We do another 5-year yield study where in the short term, we might be getting back to crossing over and going positive. We're already positive in the intermediate term, where longer term, we're in a downtrend. But if you compare that with what you see in the chart, it's like, where's this indicator getting that from? Then we look at a long-term bond ETF based on price, where it's been in a downtrend. Short term, we're in a downtrend. Long term, we're in a downtrend. But here, long term, it still has this as in an uptrend when we're using the KST. So, and I'm not quite sure what to make of that. Then we have the MOVE index, which measures the volatility of bonds. And then in the middle area, we have the VIX, which measures the volatility of stocks. And we can see right now that there's a pretty strong correlation between the two. We look at the price of the 30-year bond on a monthly chart where we're in a longer-term downtrend. The ratio down at the bottom shows that bonds are outperforming the CRB index, but we might be starting to see a shift there. And that's why we're seeing this rolling over a little bit. The CRB is starting to turn more positive as bond prices are starting to turn more negative. So we'll want to keep an eye on this. We look at different sectors. We compare the materials sector and all the 11 sectors with the S&P, where the materials are underperforming. Communication is outperforming. The energy sector is underperforming, even though it tried to bounce back up recently. The financials, okay, remember last March with the whole banking situation? The market really hasn't recovered from that yet, especially on a ratio compared to the S&P. The industrials going more or less sideways, but still in a longer-term downtrend. Tech, which has been doing quite well in 2023 and is outperforming. Staples, which are underperforming. And look at the real trail off here. That's always interesting. Real estate continues to be in a more sustained downtrend right now. Utilities also in a pretty sustained downtrend. And then we take a ratio, and I use this as one of my possible positive scenarios. A lot of times when we hit some kind of a bottom in the market, because 2022 was so choppy, and then this ratio starts to go up, that often gives really good support to the S&P. Well, we've still been going up with this ratio, but look at the problems that we ran into in August. Is that eventually going to feed through and give more support to the S&P? It hasn't really worked as it has been in the past. It hasn't been working that way right now. We look at healthcare, more of a value area, because you have to have healthcare no matter what's happening economically, still underperforming the S&P. And here's another chart showing how healthcare is underperforming. We look at discretionary, which is one of the stronger areas in 2023, and they're outperforming the S&P. Look at staples. These are the things that you have to have no matter what's going on in the economy. They held up a lot better in 2022, but now we're seeing some more weakness in 2023, but they're still in a sideways uptrend. We look at the tech sector, which continues to be strong. And we look at the semiconductors, also continuing to look strong. And then the tech sector, when you compare it to the S&P, the tech sector is really outperforming. When we look at energy, which did great in 2022, compare it with tech, which did bad in 2022, now we're seeing just a reverse of that as energy has been underperforming. We look at growth stocks and compare them with bonds, where growth stocks have been really outperforming. We look at the tech sector and the rise in interest rates, where tech is outperforming. Here's an inverse showing how the rise in interest rates are underperforming. Discretionary compared to staples. This helps the growth versus value scenario, showing how discretionary is outperforming staples. And this shows how staples are underperforming discretionary. Gold, even though it's in a longer term uptrend, it's really been underperforming the S&P. It's also been really underperforming the dollar. And then high leverage loans. And I say this every time I do a video. If the economy was getting ready to fall off a cliff, would this ETF be going up the way it is? These are risky loans. And these are the first to go down when the economy starts to hit the skids. Look at this. It's really seeing a good solid uptrend. So the folks that invest in this, you could either say they're clueless about what's going on, or take it for what it is. The way I take it is that these people are pretty smart, so they kind of understand what's going on. So we need to know that this is happening. Looking at the NYSE composite, still in an uptrend. All stocks, after falling back a little bit, is still in an uptrend. Emerging markets, they're chopping more or less sideways, but still in an uptrend. The microcaps, the really small companies, they are actually in a downtrend right now. What we're watching for here is, are they going to eventually break below 100? Because earlier in the year, they did, and they set a new 52-week low. They've been holding up so far, but we'll want to keep an eye on this. Then we look at the home builders. We have the S&P on top, the home builders ETF in the middle, and then the ratio between the two, and they've been going up as they've been bouncing this past week, and the relationship between the two is fairly strong. We look for divergences in this chart when one index, maybe the S&P is going up and home builders are going down, or vice versa. We're not really seeing any of those divergences right now. Bitcoin, which is still in an uptrend, but is in danger of seeing a death cross here. It broke out, it got up into the low 30s, and then it broke down into the 25s. We saw a little bit of a spike up later on in the week, but then it just seemed to come right back down. And then internationally, where China is still in a downtrend, trying to turn up, we're turning up in the emerging markets. We've turned more positive in Europe, trying to turn back up in Japan, and the S&P is also trying to show some improvement. Looking at the InterMarket Analysis chart, going back to the beginning of the year, where stocks are doing the best, followed by oil. It's just shooting higher, and then gold, and then the dollar, where as we entered August, bonds based on price started to go negative. Looking at some correlations, we have the S&P to the dollar. This is neutral now. When we're at plus 0.25 and above, they have a tendency to go in the same direction. When we hit the minus 0.25 and below, they're going in opposite directions. When they're in between here, I consider them to be neutral. We also look at the price of oil and compare it to the S&P, where they're having a pretty strong tendency to go in the same direction. Then we look at the S&P and compare it to the 10-year yield. They're having a tendency to go in opposite directions. We look at the tech sector and compare it to interest rates, also opposite directions. And then we look at the S&P 500 to shorter yields, like the 2-year, they're also having a tendency to go in opposite directions right now. Some long-term secular, which means long-term, and cyclical trend studies. This is a monthly chart of the NYSE. We're above the moving average, so that's positive, even though we're seeing some weakness. The Koppel curve, another momentum oscillator, is crossing above zero. So this suggests on a broad market level, we're seeing some real improvement overall. Then we look at a daily chart of the NYSE, and then we look at the NYSE record high percent index, where it's been bouncing back up, even though it's chopping down recently. This is also suggesting on a shorter term basis that things are turning more positive. When we look at the S&P and compare it with the PPO, another oscillator, it was rolling over just a little bit, and this is a monthly chart, but it's still maintaining an overall uptrend. Then we look at the S&P and compare it with commodities. Well, they both have been doing okay. The S&P had some weakness. The CRB is seeing some strength, but we're not really seeing that reflected in this ratio on the bottom. And then we look at another measure between the S&P 500 and a monthly chart of a global index, where we're above an advancing moving average. And again, the KST, this might be leading us a little bit astray right now. So at the very end of this, what I do is I take all the things that are positive, and my definition of positive is when the 50-period simple moving average is above the 200-day simple moving average. First on our list is the growth indexes and ETFs. The CRB index, that's a relatively new addition. The biggest software companies, the euro and the British pound compared to the dollar, even though the dollar's been seeing some strength compared to these currencies. Gold and silver still in uptrends. The mega caps, the low volatility ETF, even though it's been chopping sideways. The Dow Jones Composite Average. FANG and ARK have also been in longer term uptrends. Bonds, where we're seeing the high yield investment grade, seeing a little bit of a weakness in the investment grades, and that may get switched over to the list if we see some more to the negative side, the negative list, if we see some more follow through weakness. But the corporate bonds and junk bonds continue to be positive. The staples are still positive for right now, tech and semis, high leverage loans, which may be surprising to some folks. The Dow, the mid caps and the small caps, the NASDAQ and NASDAQ 100, the NYSE composite, all stocks, emerging markets, and Bitcoin. These are longer term uptrends. Then we look at what is negative, and that's when the 50-period simple moving average is below the 200-period simple moving average. The value index is getting close, but haven't quite crossed over positive yet. Copper, seeing a recent death cross. The US dollar index longer term on the daily chart. Shorter term on the daily chart. Longer term, it's turning positive. The Japanese yen to the US dollar. shows the Japanese yen is underperforming. The total bond ETF, world bonds, the micro caps still showing some weakness there. So thank you. I really hope you found this helpful. I do produce a lot of videos throughout the week. I do one every day. I have a weekly video. I have this video. After this, I'll do what I call the deep dive video. I hope you can find some value in these videos that I do upload. I hope you're having a really good weekend, and I will talk to you in the next video.